read a short citation of our speaker. Dr. Asolo is a partner at Aluko and Oyebode and a member of the Mergers and Acquisitions and Capital Markets teams. He also heads the firm's fintech startup team. With experience in the regulation of banks, fintech entities, capital markets operators, derivatives markets, and financial market infrastructures, he provides advice to clients on debt equity capital market transactions, mergers and acquisitions, antitrust matters, corporate restructurings, and regulatory compliance. Most recently, he was the group company secretary and legal counsel in the financial market infrastructure group, where he had legal, company secretarial, and relevant compliance activities within the group. In this role, he was a member of the Exchanges, Listings, and Quotations Committee, where he served as a legal subject matter expert, responsible for dimensioning legal, compliance, and regulatory risks connected to financial products and securities sought to be admitted to the exchange by issuers. He holds a PhD in financial regulation and derivatives from Durham University, an LLM in international commercial law from the University of Birmingham, and an LLB honors from the University of Wolverhampton. Ajibola is recognized by leading global law firm directories such as IFLR 1000. Ladies and gentlemen, let's welcome our speaker for today, Dr. Ajibola Asolo. Thank you very much.
Thank you very much, Abigail. Thank you very much, Dr. Konuji. Before I dive into it, can you just confirm that you can hear me clearly?
Yes, we can hear you clearly.
Brilliant, brilliant, brilliant. Thank you very much once again, Dr. Konuji and Abigail. Thank you for inviting me to this monthly seminar that is conducted by the Lex Lata Center. You're doing good work, and I very much commend you for all the work you do in the area of international law, just generating more leadership, more thought leadership, and more understanding in these perilous times. The topic that I'm going to be speaking on today is going to be on derivatives. I understand that everybody can see the slides that are before them at the moment. Derivatives, well, financial derivatives sit squarely within the. If you're not speaking, can you mute yourself, please? Just so I'm not distracted. Financial. Thank you very much. Financial derivatives sit squarely within the remit of international law. So it's very much. This is very much a topic that is within the core of what Lex Lata does in terms of the knowledge that the center is trying to proliferate as an organization. So without much ado, I'll just dive into it. And if anybody has any questions at any point, please stop me. Or if you have any comments, please stop me. Please feel free to interrupt, just unmute yourself and indicate. Or just raise your hand and indicate that you've got a comment to make. So I'll just dive into it very quickly. As I said, derivatives, the regulation of financial derivatives is very much a regulatory function that sits within the remit of international financial law. And we're going to start off this session by trying to understand properly what derivatives are as a starting point. You might have heard about these financial instruments referred to as derivatives, whether on the news, you might have heard about them, during the last financial crisis. What are these instruments? So we'll dive into that. A derivative is a contract or a financial instrument, right, which derives its value from the value of an underlying asset at a future date. And the value of a derivative will often be dependent on the value of the instrument in the underlying cash market. Let me try and conceptualize that for the benefit of people that do not know what that is. a lot of you will be familiar with some of the issues in the financial market, in Nigerian financial markets, as it pertains to foreign currency. So you would have heard that Naira is now 1,000 to $1. Where a market participant or a bank or a client or a customer such as yourself, where you have Naira and you seek to purchase USD, i.e. dollars, to discharge some particular obligation, maybe you want to pay school fees, you want to do anything of the sort, the contract you enter into with your counterparty, i.e. a bank or even simplistically a malam, to buy the dollars, that particular contract is what is referred to as a derivative, right? It's a derivative because that contract you've entered into with the bank or the malam to procure the dollars derives its value from the value of the USD or the Naira. That is what a derivative is. And there are many types of derivatives, right? You have, from this screen from this slide that you see before you, the example that I've given you is what you call a currency derivative, which is, in this shapes you see on your screen, where you've got Naira under currencies. What I've described, the example that I've conceptualized, is a currency derivative. It's also possible for this instrument to be based on other assets or concepts, such as commodities. You can see a corn in the corner, and bonds, and stocks, market indices, and interest rates. That is what. I'm sorry, can you hear me? Can anyone just confirm that they can hear me, just to be sure?
Yes, sir. I can hear you.
Okay.
Yes, sir.
Yeah, so very simply, thank you very much. Very simply, what I've described is a derivative. Moving on to the next slide. As I said, hello, can you hear me?
Yes, sir.
Please, let's hold on for Dr. Asolo. I believe he will join us shortly. I think he's having some technical issues, but he will join us very soon. Can you all hear me, please?
Yes, sir.
Okay,
Yes, sir.
so please just hold on, just a few minutes. I believe he'll join us soon. Dr. Sola, can you hear us?
Hi, good afternoon, everyone. Can you Can you hear me now? Can you please confirm you can hear me? My sincere apologies. I keep getting thrown out of the room repeatedly.
Yes,
Yeah,
sir,
we can hear you. Please go ahead. No problem.
Yes, sir, we can hear you.
Okay, my apologies. Let me try and share my screen once more time, once again. Okay. Okay, the system tells me that my screen is being shared now. Sincere apologies to everyone. Let me just try and repeat what I've said very quickly. I was trying to explain what a derivative is. I conceptualize it as I use the example of where for any reason, any one of us in this room might be trying to buy USD dollars. So if you wanted to, for example, pay for school fees, the act of the contract you execute or enter into with the bank, or very simply with a malam, where you buy the USD for Naira, is itself derivative contract, because the value of that contract is linked to the value of an underlying asset, i.e. the USD. And I said that a derivative contract can be based on any number of assets. From the screen before you, or from the slide before you, you would see things like stocks, bonds, commodities, currencies, which was the example that I gave you, and then interest rates. All these are types of assets that derivatives are based on. I will now move to the next slide. Let me quickly go through the different types of derivative contracts that you would see around you in the financial system, whether it be the local financial system or the international financial system. There are four broad categories, or four types. There's one referred to as the forwards, right? A forward is a contract which allows transacting counterparties fix the price that they wish to trade or buy an asset for at a future date. That is an example of, let me give you an example of what a forward is. So if in the example I gave you, let's flip it a little bit and say that you're going to have a foreign currency obligation that you are aware of in like 6 months. So you know that 6 months from now, you're going to be looking to buy or pay your school fees in the UK or the US, and you're going to need USD to do that. You know that the rate today is 1,000. There's no way to tell what the rates will be in 6 months. You then go to your counterparty, i.e. a bank or a malam, and enter into a forward contract. Your counterparty, based on the historical performance of the Naira against the dollar, can make an assessment or take a view that I suspect that in the next 6 months, Naira will be at 1,200 against the dollar. Both of you can then enter into a forward contract which you will document and sign that 6 months from now, that your counterparty, i.e. the malam or the bank, will make USD available to you at the rate of 1,200 or whatever you might have agreed, and you will make the Naira available to him. That is what a forward contract is. So it allows counterparties fix the price that they want to trade or buy an asset at a future date. That's a forward. A future is an agreement between two counterparties to trade an underlying at a specific price on a future date. So a forward and a future are normatively similar things. The only difference between a forward and a future is that in the example that I gave you previously, it is just two entities, two parties. It's bilateral. Whereas in a future, it's standardized and it's traded on an exchange. So to enter into a futures transaction, you would need to go to an exchange to do the contracting. An example of an exchange where you enter into a futures transaction is you can enter into equity futures on the Nigerian Stock Exchange, and you can enter into foreign currency futures on the NGX in Nigeria. You can enter into commodities futures on the Chicago Mercantile Exchange in America. A third type of derivative is what you call an option. An option gives the buyer a right, but not an obligation, to buy or sell an underlying at the pre-agreed price in the future. So you might have heard about things called
Yeah, close my door from.
Okay, if you have a question or a comment, please feel free to jump in. But if you don't have a question or a comment, kindly mute yourself. Thank you. As I was saying, an option is a derivative contract that gives the buyer a right, but not an obligation, to buy or sell an underlying at a pre-agreed price. You might have heard about options contracts in the context of an equity transaction, or in the context of an employee relationship. Broadly speaking, an option is a derivative contract that allows somebody, a beneficiary, it gives you the right, but not an obligation, to buy or sell an asset at a future date. And the last broad category of derivatives is something called a swap. A swap is an agreement between two counterparties to periodically exchange cash flows based on an agreed underlying at the predetermined rate or price in the future. A swap derivative typically comes into place where you have counterparties that have obligations in different currencies. Imagine that one counterparty has to pay back a Naira loan every month, and another counterparty has to pay back a USD loan every month. But at the same time, both counterparties have USD and Naira obligations. They then swap their cash flows to meet their obligations in the other commercial arrangements. Broadly speaking, that's what a swap is. And now move to the next slide. What are the features of derivatives? I think let me just pause here and explain that a derivative is a financial instrument that is similar to any other financial instrument, such as shares or bonds or commercial paper. It's an asset, right? It's a financial instrument similar to any other financial instrument. You need to understand it that way. What are the broad features of these instruments that we call derivatives? I'm going to talk about 5 broad features here. The first feature is that they require little or no cash flow at initiation. If you think about the example of a forward that I gave you, when you want to buy if you need your USD in 6 months, but you want to lock down the rate today, to enter into such a transaction, where you have a conversation with your counterparty you pay something called a premium to your counterparty. So that premium could be, for example, if what you want in 6 months is $10,000, you can pay anything between 1 to 10% of that to your counterparty, essentially to lock down that obligation. And then when you get to 6 months from now, that counterparty delivers the USD to you at the agreed rate, and you then give them the Naira at the agreed rate. So to initiate a derivative transaction, it requires little to no cash flow. Remember that I said you can initiate, in the example that I gave, you can initiate that contract at anything between 1 to 10%. And the second feature is that derivatives are traded either OTC or on exchanges. What OTC means is over the counter. Again, the example that I gave you is an over-the-counter exchange, i.e. you go to your Malam to get USD, that's an over-the-counter exchange. Or where you enter into a derivative transaction on either the NGX or the FMDQ. The NGX is the premier securities exchange in Nigeria, where they list and trade financial instruments such as equities and equity securities, while FMDQ is the exchange where they list derivatives and debt instruments. Where you enter into the contract on an exchange, that is called an ETD, i.e. exchange traded derivative. Where you do it bilaterally between two counterparties in the financial market, it's called an OTC, i.e. over the counter. A third feature is that it could be standardized or non-standardized. So a standardized contract is a derivative that will be listed on an exchange where the size and the tenors will be listed. So let me give you an example. For deposit money banks in Nigeria that enter into OTC FX futures on the FMDQ, those contracts are standardized, i.e. you typically enter into them at sizes of $500,000, and the tenors are typically standardized, i.e. it could be 12 months, it could be 18 months, it could be 36 months. Whereas for non-standardized derivative transactions, you can modify the terms as you deem appropriate. You can modify the tenor or the size as you deem appropriate. And the fourth characteristic or feature here is that it will have a defined and limited tenor. As I said, a derivative contract will have a tenor. In the original example that I gave when this seminar started, where I referred to a situation where you need dollars in 6 months, in such an example, your derivative contract will have a 6-month tenor. And then fifthly, as I said at the beginning of the session, a derivative contract will derive its value from movements in the value of the underlying asset. Then move to the next slide.
Hi, Ajibola. Hello, Ajibola.
Yes, sir.
Okay, this is Sifas.
Hi, Sifas, please go ahead. I don't know if it's just me, but I can't hear Sifas. But just to be sure that the problem is not from my end, can I confirm that?
Okay, we'll be having a question and answer session at the end of the presentation. So we're asking all our guests to please reserve their questions for after the presentation. So as soon as...
okay, no problem. Okay. Yes. Jibola invited questions, but okay. Noted, no problem.
Yes, thank you.
The next slide I'll speak to is, having addressed the features, let us now look at what the uses are for these instruments and who the users are. In my, conceptualize this for people in the room. There are three broad functions of derivatives. There are three broad functions. Well, there are three users, but two broad functions. Let me say there are three user categories and two broad functions. Right? So the first function or use of a derivative is to manage risk. Let me conceptualize it again by referring to the example I just gave you, where and using the naira, using the depreciation of the naira as an example. Where you know that you're going to need naira in 6 months, you're going to need USD in 6 months, pay for, or maybe an import you want to do, or to pay for your child's school fees. You know you're going to need it in 6 months. But you also suspect that because the naira has been deteriorating for the last couple of years, you suspect that it might reach 1,500 in 6 months' time. I mean, we do not hope for that, but you suspect it might happen. You can manage that risk by trying to lock down the value at which you procure that USD today. So you can enter into either a forward contract, or you can enter into, because it will be bilateral, you enter into a forward contract. So you would agree with the counterparty that has USD or that earns USD, that look, my counterparty, in 6 months, I'm going to need USD. Let us agree a rate today. The counterparty can be generous and say, let us peg the rate at 1,200. You both sign, and you pay him a premium to lock down the contract. Your premium could be $100 or whatever it is. You pay a premium just to show that you're serious, and you lock down the contract. When you then get to 6 months from now, your counterparty has the obligation to deliver the dollars to you at 1,200, and you will then give them the Naira equivalent. That is the way you would have managed your risk, because when you then get to that 6 month time frame, it could very well be that the Naira to the USD now sits at 1,007. But because you have locked down the rates now, today, your counterparty is contractually obliged to deliver the USD to you at 1,200. That is a way of managing risk. Another broad function or use of derivatives, based on the example I've given, is you can use it to, you can speculate with it. So speculators will often try to make a profit from forecasted future price movements of the underlying asset. In this country, you are obviously we all know that again, using the FX market as an example, it's been deteriorating over the last couple of years. We're aware that speculators would have been taking positions in the FX market just to make a profit. So imagine in the example that I gave, the other person on the other side of the transaction, imagine if they have a constant flow of USD and they enter into such transactions with so many counterparties, they will be making profit and speculating. The third use is, again, it's profit making, but this is where people take simultaneous positions in related markets to generate risk-free profit from the underlying price movements of assets. Again, using this example that I gave, right? Imagine if you had both a consistent supply of USD and a consistent supply of Naira, and you're taking positions consistently in both markets, i.e. the Naira market and the USD market with different counterparties. Imagine how you're making profits and banking cash from those two different markets. Those are the broad uses of derivatives. I think the final point I'll make on this particular issue is that the actual contract that you enter into, using the example of this Malam, the actual contract you enter into, right, where it's signed and documented, it is itself an asset, right? So where I enter into this transaction, again, to buy USD in 6 months at $1,200, 1,200 Naira to the dollar, imagine that we get to month 3 or 4, and I change my mind, and I see that, you know what, I'm no longer going to need this USD in 6 months. I can literally take that contract and sell it to someone else at month 3. And that person, when he gets to month 6, will then be on the other side of the transaction and will then go and collect the USD. So a derivative contract is itself an asset. And who are the people that use these instruments for all these functions that I've outlined? You have entities like governments, banks, non-bank financial institutions such as pension funds and insurance companies, and corporates like Dangote, Bua, Olam, big commodities dealers engage in these transactions, and obviously retail investors. A lot of us enter into derivative transactions in our daily life, but we don't realize it. Those are the people that use these instruments. Let me now move to the next slide. A lot of the things here I've already touched on previously. So, the types of markets, I kind of touched on them. There are 2 broad markets for derivatives. You have what we refer to as the over-the-counter market. This is the market where individuals engage in these transactions on a bilateral basis, i.e. counterparty A. So imagine myself and Dr. Wale Kuneji entering into a derivative contract that is based on foreign currency. That would be an over-the-counter transaction. And the features would be that obviously there's no transparency in such a market because it's not regulated, and the exposure risk is high. So imagine that I enter into this transaction with Dr. Kunuji, and maybe Dr. Kunuji is to collect USD from me 6 months from now, and when we get to month 5, I have an accident and I'm in the hospital and I can't talk. I can't remember my bank details. That is what they call counterparty credit risk. It's high in such a market. And another feature is that you can modify the contract as you want. The exchange rate, these are derivative transactions that occur on exchanges such as the NGX, such as the CME, such as the NASDAQ and New York Stock Exchange. In these markets, transparency is high because all the information there's price discovery. All the information is on an exchange. Everybody logs onto the terminals in the morning to see what the prices are, and they can buy and trade these instruments. Counterparty credit risk is low in this market because of something called essential clearing counterparty that I'll explain shortly. And in this market also, you engage in multilateral trades with standardized contracts. I'll now move to the next slide. What are the benefits of derivative transactions? I'll speak very quickly to 5 broad benefits. It can impact the growth of a country because it enhances the ability of institutions to lend. Where you have let me explain this. Where you have a very vibrant derivatives market, right? In effect, you will see that economists will tell you that in very vibrant derivative markets, banks don't have to hold a lot of cash. Therefore, they have more cash to lend to the real sector. So that is a benefit of a vibrant derivatives market. Another advantage is that it engenders financial innovation and market development. The Nigerian derivatives market is an example. Over the last 3-4 years, we've seen many developments in the market with the enactment of derivative provisions that are outlined in the Companies and Allied Matters Act 2020. We're seeing financial innovation and transparency in our markets. And thirdly, with the regulators involved in the derivatives markets, they now have much more credible information as to the performance of these instruments and the broader financial market ecosystem. And fourthly and fifthly, just broadly speaking, there's increased product viability or availability. As I said, the traditional financial instruments we have, or that we've always known as people, would be things like shares, bonds, and things of that nature. But now derivatives are an additional asset class in addition to shares, cash, and bonds. And then fifthly and finally, derivatives allow corporates and companies plan properly and manage risk. Think back to the example I gave where if you know you're going to need USD in 6 months, you may want to lock down the rate now. That way you can plan properly. You don't get to month 6 and you're now scrambling looking for cash to meet your foreign currency obligation. Let me very quickly speak to exchange traded markets. I mean, I'm going to try and be as simplistic on this matter as possible, because I realize that some of our students. The exchange traded market is the market that concerns regulators the most. So in Nigeria, for example, it will be regulators like the SEC, i.e. the Securities and Exchange Commission, and the CBN. They'll be concerned about these markets. The market infrastructures, i.e. the platforms you require to trade this instrument in the exchange traded markets would be things like an exchange, i.e. a securities or derivatives exchange. An example of a securities or derivatives exchange in Nigeria would be, as I said previously, the NGX, or the NGX formerly known as the Nigerian Stock Exchange, or FMDQ. In the UK, it will be a platform such as the London Stock Exchange, or in America, it will be a platform such as the New York Stock Exchange. Second principal market infrastructure you require in an exchange-traded market is something we call a central clearing, i.e. a CCP. Very simply, a CCP is an entity that interposes itself between participants that are trading derivatives. Cast your mind back to the example I gave between myself and Dr. Kunuji. Imagine we enter into a derivative transaction, right? And somebody has an accident before we get to month 6. And one person is now not able to deliver cash to the other person because he's had an accident and has died. A CCP is the infrastructure that interposes itself between Dr. Kunuji and myself, right? And I'm going to speak about this very simplistically. Just imagine that CCP interposes itself between Dr. Kunuji and myself and collects cash from each of us as the market moves, as the price of USD fluctuates or advances. So as it fluctuates, the CCP will collect cash from, if it's Dr. Kunuji that is supposed to put cash down, he'll put cash. If it's me, I'll put cash. So a CCP is the infrastructure that effectuates the management of that counterparty credit risk that I spoke about earlier. So it makes markets safer. And then the third principal infrastructure is what you call a CSD, i.e. a central securities depository. A central securities depository is an entity where financial assets are stored, where you store evidence of your shares, your bonds, your commercial paper, things of that nature. And then finally, of course, the payment system, which is plugged to the banking system. So as when we get to month 6, when somebody is due to transfer cash or wire cash, you effectuate that on the payment system. All the stakeholders are on the other side of the screen. The stakeholders are things like the regulators I mentioned, the SEC and the CBN. You have the banks and the non-banking financial institutions who engage in these transactions. And then you have governments, corporates, and individuals. And then finally, of course, you have members of the media. I'll now move to the next slide. This slide, right, conceptualizes what I said. It's a bit technical, so I'm not gonna dive into it. But if there's anybody in this room that is dying to understand what this slide is, by all means, please, you can contact me after this session. But let me just simplistically try and explain what a CCP does. Recall that I said that in the example between myself and Dr. Kunuji, a CCP is that market infrastructure, right, that administers the issue of counterparty credit risk, right? The 4 broad operational concepts by which a CCP will administer these counterparty credit risks are the things that are outlined before you here. These things are called novation, netting, margining, and default management. All these things are principles under international financial law, right? They are standalone principles that are readily recognizable to international financial law academics and practitioners and lawyers and bankers on their own, right? But I'm not going to dive into it because I think it would not do the room justice. So therefore, the most simplistic way that I'm going to put it is, these are the 4 concepts that kick in operationally that enable a CCP address that issue of counterparty credit risk that I alluded to earlier. Counterparty credit risk that I alluded to earlier of an individual dying, right, is visualized or kicks into play in the financial system or in a commercial context where a company goes into liquidation. And I'm going to refer you guys in the room to the issue of the insolvency of Lehman Brothers in around 2008, where we had the global financial crisis, right? what happened with Lehman Brothers, i.e. going into insolvency, is an example of counterparty credit risk kicking in, i.e. when Lehman Brothers was going to go into insolvency, it had entered into over 900,000 derivative transactions with, that were valued at tens and tens of billions of dollars with hundreds of counterparties across the world. Imagine that there was no infrastructure to properly administer claims and ensure that whoever is due cash will receive their own cash, and who they are to receive cash from, they properly receive it from. It would have been a financial mess. So that's what CCPs do. CCPs engender stability by administering or preventing counterparty credit risk from crystallizing. It is these four concepts that are before you that help CCPs effectuate that process. And now move to the next slide. I'm going to localize it for us in Nigeria now. We do have a relatively vibrant derivatives market in this country. As I alluded to earlier, when the Companies and Allied Matters Act 2020 was enacted, extensive provisions that govern derivatives were outlined in that law. I think from section 715 thereabouts, or 7 something, you'll see extensive provisions on OTC derivatives that are outlined in the CAMA. In addition to the CAMA, in 2019, the Securities and Exchange Commission issued rules and guidelines that pertain to derivatives and central clearing counterparties, right? So we do have what is a relatively vibrant derivatives market. We also have infrastructures in Nigeria where you can enter into these transactions. So on the screen before you right now, as I said, the rules on derivatives trading that are issued by the SEC apply to ETDs, and all derivative contracts must be registered with commission before they can be traded on an exchange. And only CBN licensed commercial banks and merchant banks are eligible to register as derivative clearing members with SEC. And also, there are requirements for CCPs to maintain sufficient cash collateral to meet their obligations. I'm going to dive to the next slide now and just kind of wrap it up here with the infrastructures we have in Nigeria. As I've alluded to through the course of this seminar, there are a number of infrastructures in Nigeria. On the exchange side, there's a company called FMDQ Securities Exchange Limited. On that platform, you can enter into derivative transactions. There's also the NGX, Nigeria Exchange Limited. They also provide a platform for equities and equity derivatives. There are two, and they're moving to CCPs, i.e. clearing houses, central clearing counterparties. There are 2 of those in Nigeria. There's an entity called FMDQ Clear Limited, and there's another entity called NG Clearing Limited. On the CSD side, i.e. Central Securities Depositories, there's an entity called FMDQ Depository Limited, and another entity called CSCS PLC, i.e. Central Securities Clearing PLC. Just kind of bring it all home and wrap it up. We do have a vibrant derivatives market in Nigeria, relatively speaking. Derivatives are, in addition to financial instruments such as shares and debt, they are a financial asset class that stand by themselves. And thirdly, the area of financial law that we call derivatives law sits squarely within the framework of international law that the Lex Lata Center seeks to proliferate knowledge about. And then finally, it's a growing area of law. And for people in this room that might be interested in the financial markets, it's an area that I encourage people to look at. I think that brings us to the end of this session, and we'll now take any questions and comments that participants might have. Thank you very much.
Thank you very much, Doctor, for that wonderful presentation. So there are a number of questions that have been typed out. The first one is from our very own Executive Director, Dr. Kuniji. And his question is that in a forward transaction, what happens where a premium is not paid to lock down the contract and the counterparty agrees? Will the contract still be valid? Can either party back out of the contract before the due date on the ground that no premium was paid? That's the question, sir.
Yeah, thank you very much for that question. Yes, so where a premium is not paid, the transaction will not be, depending on the terms and how it's crafted, where a premium isn't paid, either the transaction doesn't go into effect or after a while, it falls away. So, I mean, in a forward, if you don't pay a premium, it either does not go into effect or at some point, say like a month or two, it falls away. That'll be the response to that. Thank you.
Okay, Doctor, thank you very much. The next question is from me. My question is that how relevant is Forex trading to the whole concept of derivatives? And under which of the derivatives can it be classified?
Thank you very much. That was a very brilliant question. Foreign currency trading is very, very relevant to the concept of derivative transactions, particularly in emerging and frontier markets, such as those in Africa and Asia. In localizing this to Nigeria, for example, the most active part, the most active derivatives market segment we actually have is foreign currency derivatives. People trying to essentially lock down rates for future obligations. So whether it be big industries like Honeywell, Dangote, or buying instruments through their banks. And they broadly fall under two classifications, Abigail. First classification would be forwards or futures. It will be a forward where it's just two counterparties, i.e., so say, for example, BOA enters into a derivative contract with Shell, which has lots of dollars. That would be a forward. But where BOA buys a derivative contract through its bank on FMDQ, that would be a future. So those are the categories. Thanks.
Okay, Doctor, thank you very much for that answer. The next question is from Precious, who is asking 3 questions. So number 1, you explained that with options, there exists a right rather than obligation. If, for example, the seller of an option contract fails to perform, bearing that they have no obligation, what are some means of legal recourse available to the buyer who holds the right?
Yeah, so your recourse would typically be legal. Again, it'll be dependent on the terms of your contract, but in the real world, there would be a dispute settlement mechanism that will be outlined in your contract, where that would kick in, right? If it's an exchange traded, if it's an exchange traded option, right, which you have, the CCP that I alluded to earlier would typically have collected enough collateral to make whole the counterparty that is aggrieved. If it's an OTC option where there's no CCP in the dynamic or in the mix, your recourse will most likely be to the dispute settlement mechanism that you've outlined in your contract, and it could be a court of law or it could be arbitration. But typically, for the more sophisticated transactions, it will typically your dispute settlement mechanism will typically be under English law in an English court for the big transactions. That's what you'd get. Thank you to the questioner.
Okay, Thank you very much. So Precious's second question, she's asking, for OTC derivatives, you mentioned that they are less regulated. How then are the market players of these financial instruments protected by the law in the way that CCPs protect against counterparty risks? Thank you.
Yeah, so in the OTC markets, the OTC markets, there's not a lot of protection. There's not a lot of protection. You enter into these markets, and the risks sit entirely with you. In the more sophisticated derivative transactions, you will typically have something called a settlement agent in between that kind of tries to mimic the role of a CCP, right? So in what you call an ISDA transaction, for example, you might have a settlement agent that will be trying to mimic the function that a CCP plays to try and mitigate against counterparty credit risk. But where you don't have any of those mitigants, all risks lie squarely on the counterparties, and they deal with their risks as it crystallizes. Thank you. What's the next question, please?
Thank you, Dr. Asolo. The next question is, as a derivatives lawyer, what type of transactions do you advise on? Could you please share a bit about your role? Thank you.
Thanks a lot, Precious. So as a derivatives lawyer, as derivatives lawyers, we advise financial institutions such as banks and multilateral agencies. Much of our function involves advising deposit money banks, such as the foreign banks and the local banks. These banks often enter into these transactions with their clients or customers, and they often want to know about the validity of their contracts. They often want to know what the regulatory framework is. They often want to know what recourse they will have if a counterparty went insolvent, which is a big risk. The advice we provide is typically over the phone or by way of legal opinions, and then explanatory clarificatory calls often follow. So that's the work we do. Just advising financial market counterparties on these transactions, whether they be foreign banks, the JP Morgans, the Goldman Sachs of this world, and then sometimes multilateral agencies as well, such as the AFC, the IMF, and AFDB, and such entities. That is what the work entails. Thank you, Precious.
Thank you very much, Dr. Asolo. The next question is from Ronke, and she wants to ask, she says, my question is this: like other financial instruments have disadvantages, what are the disadvantages of derivatives? Thank you.
The disadvantage of a derivative is that they do have some derivatives, right? I'm sorry, they do have some disadvantages. Absolutely clear. They can be very complex instruments, right? They can be very complex instruments, and because the entry barrier is low, right? Because the entry barrier is low, it's possible to enter into a significant number of derivative transactions, right? Where you would have vast financial obligations, where a risk to crystallize, and where there's an issue in the financial market, you can quickly see how such a risk can be externalized onto the broader financial system. And I'll give an example of what happened in 2008. In 2008, I think one of the first companies to have problems was, I think, AIG. A bunch of companies had issues. AIG, Bear Stearns, Lehman Brothers. But Lehman Brothers was the only company that was allowed to fail, right? And once that happened, derivatives act as a channel to externalize counterparty credit risk onto the broader financial markets. So what that means in simple terms is, imagine in Nigeria today where I'm not going to use a specific name, but imagine where a systemically important bank in Nigeria were to fail based on some wrong trades or transactions. Imagine how that would quickly externalize into the broader financial market, because they would have counterparties like all the deposit money banks in the country that they would have entered into agreements with. That would quickly externalize and cause chaos in the financial markets. And then customers such as yourself, certainly myself, I will quickly go to any bank, any bank I have my 10K, I'll go and collect my 10K immediately. So imagine if millions of us are doing that because the bank is failing. There'll simply be no more money in ATMs, no more money in the bank. So derivatives can be dangerous instruments. In fact, I think that Warren Buffett has called them weapons of financial mass destruction. If you Google that phrase, you see more about that. So they can quickly act as a conduit to externalize financial market risk. So they can be dangerous where you don't know what you're doing. So thank you for that question.
Thank you, Dr. Asolo. The next question is from Monique, and she's asking, she says, you explained the differences between over-the-counter and exchange-traded derivatives. Do you have a preference, and what would be advisable to use, considering over-the-counter seems more accessible?
My advice, I mean, as a lawyer and as someone who likes orderly markets, obviously I favor exchange-traded derivatives just because there's more transparency, there's more price discovery, there's more visibility, and there's more order. So my regulatory inclination as a legal practitioner would be towards exchange-traded derivatives. But I do recognize that OTC derivatives too can be very useful because you can modify them to suit your particular circumstance. But just generally speaking, I favor exchange-traded markets because I like order. And that's an orderly market. Thank you for that question, Monique.
Thank you very much, Dr. Asolo. Our question is from Stella, and first question is, why the term counterparties and not just counterparts or some other term?
That's an interesting question. Counterparties, I think counterparties is a more appropriate term because it's possible for it to extend beyond just one individual. Just one entity. So in an exchange-traded market, for example, your counterparties will be multilateral. You can be on the opposite side of a transaction to more than one party. So broadly speaking, in a market such as this, counterparties is a more appropriate term. Thank you, Stella.
Thank you, Dr. Asolo. To our last question, again from Stella, and she's asking, she says, if I understand adequately, there is to be a derivative contract. Derivatives are not by themselves contracts. In a contract for derivatives, can the contract be voided if, for example, there's a contract for the transaction of $1 for 1,200 Naira in 6 months, but there's a severe rise to about $2,000 to avoid a lot of losses for any counterparty?
No, yeah. So I can quickly speak to this. In this example that Stella's outlined and that I outlined earlier, it's if the Naira rises to 2,000 against the dollar, that is a risk that the person that the counterparties will bear, right? The counterparty whose obligation it is to supply dollars, it's that person's obligation. It doesn't go away simply because there's been an uncomfortable market event, such as a massive deterioration of the Naira against the dollar. The counterparty obligation will continue to subsist, and if you do not abide by it, the appropriate recourse to the dispute settlement system will be exercised. I hope that is clear. Thank you very much, Stella.
Thank you very much, Dr. Asolo. I think that brings us to the end of our questioning. I'll hand over to
Abigail. I think
Director.
Mr. Caleb, Cephas Caleb would like to ask a question too. Cephas.
Thanks, Wole. I think my questions have been answered, but I just want, if Ajibola, on a quick note, just I don't know the feedback on the currency swap market for Nigeria. Is there an exchange? I know a lawyer called me yesterday to ask about exchange of dollar, cross border. Somebody needing naira in Nigeria and then having dollars outside the country. All of that. So is there a place an exchange that you can just go and get a buyer, or it has to be bilateral?
Yeah, so it's not that space, that particular space itself is not a recognized market because the naira is not supposed to be an exportable currency. So those kind of transactions will have to be bilateral. There are no organized markets for that.
Okay, thanks very much.
Brilliant. Thank you very much, Abigail. Thank you very much, Dr. Koneji and members of the Lex Lata team.
Thank you so much. Thank you so much, Ajibola. This has been a very wonderful presentation, and I've learned a lot, actually. I also believe that students and research fellows, undergraduate interns, have learned a lot from this presentation. I know that quite a number of people are interested in financial markets, especially students that are about to graduate. Some of them are thinking of, okay, what should I do and all of that. I believe that this presentation, like you described it, it's a primer. Just, to let them know the sort of things that happen in that field. And I have a feeling that some people will have taken that decision today to go into financial markets and build a career around that. So thank you very much, Ajibola. And I hope that if we invite you again in future, you will accept to come and do another presentation at some point in the future. Thank you once again. We've come to the end of this very interesting seminar. I should point out very quickly that next week, Friday, we will be hosting Dr. Muntaka Umaru Sadiq. He's an advisor. He's actually the head of the Energy Transition Office in the Office of the Vice President of Nigeria, and he'll be talking about energy transition and the role of lawyers in energy transition. We are inviting all our guests to please join us on Friday, the 6th of October, 3:30 p.m. for another very interesting session with Dr. Muntaka Umaru Sadiq. So thank you very much. We've come to the end of this event. I wish you all a very pleasant weekend. Thank you once again.
Thank you very much.
Thank you, sir. Thank you, Dr. Asolo. Thank you, everyone. See you next week.
Thank you, sir.
Thank you, sir.